The ones that we are very optimistic about is the infrastructure. Anything that has to do with the infrastructure and the supply chain is we are bullish. There,
Yeah.
you made me say the B word. So anything infrastructure and the supply chain that assists the infrastructure, we are bullish. Anything that is related mining, related rare earth elements that is critical for lithium and other aspects of the technology, we are very optimistic. Gold, we are optimistic. So other than that, I think anything that says AI in front of it has to will cascade down along with the MAG-7.
Welcome back to Metals and Miners. I'm your host, Gary Bohm, and today we're digging into the stock market and specifically short selling with the CEO of Unicus Research, Laks Ganapathi. Unicus Research is an independent investment research platform. It combines fundamental analysis with hard-to-find information from atypical sources. Laks, it's an honor to have you on Metals and Miners. Welcome to the show.
Thank you so much for having me, Gary.
All right, so Lex, recently, Michael Burry, I know you know that name, he's made the news for suggesting some members of the MAG-7 are overvalued and he's shorting them. The movie The Big Short, it was made about Michael and how he made a fortune during the 2008 GFC. Now, before founding Unicus, you were a dedicated short investment analyst at a boutique investment research firm. Your company now serves many types of clients, including institutional ones, providing investment cases to short various companies. You're clearly serving a very unique area of the market and one that is misused and very misunderstood by very many people. What do you hope for those tuning into this conversation today that they're going to walk away with after listening to this discussion?
What I hope for them to walk away with is to understand and do a thorough due diligence before shorting anything, rather than following the crowd. It doesn't matter if it's Michael Burry, it doesn't matter if it is a legend short seller. It matters that you do your own due diligence because I just posted something on X. There are a lot of people, I know few of them covered Carvana short at a loss. And we have been consistent in sharing to our clients who are institutional mostly, and others who reach out to us to not short Carvana, because when you focus on shorting something, the obsession would just wipe you clean.
Okay, well, that's really good advice. And so for those tuning in, we typically talk about the metals and the miners. And this is an art and a science, really, to shorting stocks. And so I'm really excited to have Lax here to dig into this. And I think what she just shared about being patient, being researched up, so to speak, to make sure that you're making a good decision and not just following what you're hearing online. Uh, It'll protect you and your investment portfolio as you move forward. All right, so let's begin with this role that short selling plays in the markets, the challenges of shorting and the positives in shorting. Can you go into a little bit of detail there?
So what, excuse me. So shorting is critical for any market. It's if you're not a short seller, that's fine. But having a skeptical view when you're researching a company, even when you're investing on the long side, it's critical to avoid companies that you should not be long on. Having said that, short selling has its pitfalls, and what we have been saying over and over again is that just because something is a fraud, doesn't mean you have to bet everything you have until your last penny in shorting that, because the stock can be a fraud and it will continue to be a fraud and still rally longer than you can stay solvent. So as much as it's critical, it's also important to be very cautious, especially when you're a short seller.
So, Lex, how large of a factor in the markets and where you might hunt for shorting opportunities is the upcoming Supreme Court decision on whether President Trump's tariffs are constitutional or not constitutional, and if they're not, should they be repaid? Is that whole scenario going to have a major impact on the markets, in your opinion?
To be completely candid, we do not make our decision based on what the administration is focusing on in terms of macro, whether the Supreme Court decision will come in favor or will not come in favor. And that is very critical for everyone who is choosing to short, because when you short a company or a sector, it has to be focused on a company specific catalyst, not a macro catalyst. So we do not place our recommendation on a macro catalyst, but rather on a company specific catalyst. But if the macro catalyst adds further pressure to our catalyst on the short side, which is a good thing, but we don't rely just on the macro catalyst to recommend a short.
So would you categorize the macro catalyst as more like a trap for folks, an emotional trap where they might say, "Oh, this is happening over here in this part of the world or within the United States. I need to go over here and short this because it's going to have an impact." Is that more of a trap rather than the fundamentals of the company itself?
Yes, it's definitely a trap because you you know the decision with respect to your example of tariffs on Supreme Court decision. You don't know what's going on inside um, before the decision is made. You don't know. There are a lot of opaque nature when you rest your thesis on the macro catalyst. So you don't know. I mean, yen carry trade or reverse carry trade. You don't know when the top is. You don't know whether tariff judgment, whether getting a 50 basis point cut. No one knows really whether it will rally the market or reverse rally the market, because at the end of the day, market is nothing but a bunch of traders with emotions running in extremes. So you can't place your short thesis on a macro catalyst.
That
So it
makes
is
sense.
definitely a trap.
Okay. All right. So what's your view on the current state of the consumer, unemployment, and the economy, and what you see coming, and how much of an impact does that play, on what's coming up for you in your analyses?
Well, I have to refer this particular article that we wrote because buy now pay later is pretty much running the consumer economy. It's billions of dollars in Thanksgiving and Black Friday sale, and we have talked about this a lot. It's not more of a consumer spending help. It's more of the cost has increased, and you know, more than 25% of consumers are using buy now pay later for groceries. Six figure 100,000 people earning 100,000 are not even middle class at this point. You have one kid, and I have one child, and the cost you take from having a kid to having four kids goes exponentially. Doesn't matter, even if you don't go to private school, you still have the mortgage, you still have the credit card debt at an average of $5,000 per household. You have the groceries and student loan debt. It's astronomical. So consumers are absolutely broke. And the data you will see on the mainstream media, it says that consumers are sound. They are not sound.
Okay, so we have a broke consumer when we're talking about, a K-shaped economy. I'm assuming you're talking about the bottom 70% or 60% of the consumer class. The top 20% or so seem to be doing fine because they own the majority of the assets and et cetera. But my question is when it comes to the consumer class, the bottom part of the K, a lot of the equities that serve, a lot of the companies that are serving that bottom part of the K, they've been hit pretty hard. The Chipotles of the world, the McDonald's of the world, they've been hit pretty hard this last year. Um, do you expect that to continue? And do you view those kinds of companies that are serving the bottom part of the K as a legitimate sector to hone in on for shorting because of the probably the decline in earnings and revenue, or the decline in earnings and profitability?
Let me take a step back if I can. 69% of the population, of American population, are living paycheck to paycheck. So, and they're using BNPL to bridge the loan. And after COVID, there is a certain segment of people who are well off. They used the stimulus packages, increased the way of their standard of living, and so to speak. Now everything has drained down. We are seeing people who are making 100, 200,000 a year are scaling down to the lower K. So people who are earning $200,000, they are scaling down to the lower K and shopping at Dollar Tree, Dollar General. All the CEOs during the latest conference call were suggesting we are seeing the population affordability crisis is there because we are seeing people making 100,000 or 200,000 are shopping in Dollar Tree, Dollar General, Five Below, Walmart, Target. So I would say that the lower K is increasing, whereas the one's upper K is cascading down to the lower K. And that is boosting the profits, for the lack of better words, to companies who are thriving in serving the subprime consumers, like the lower end of Walmart and Target. I hope that
Okay,
answers your question.
it does answer my question, and then that makes me think. So if the upper part of the K is downsizing to the lower part of the K, and they're the bigger part of the economy, what's the impact to GDP? What's the bigger the impact to tax revenues ultimately, et cetera?
Well, the basic necessities, what the consumer need, food, shelter, clothing, those will keep on flourishing. So for instance, instead of buying a new shoe or a new pair of jeans, they would rather go sew the jeans that is torn up. Instead of getting a new microwave or new washer and dryer, they will fix it. So what we will see is more of a fixing rather than buying uh, uh, new things economy, for at least for the next few years.
If unemployment, which is now around 4.4%, continues to tick up, are you expecting the consumer in general to maybe hit a brick wall of some kind and we have a significant problem for the consumer?
Um, Yes, but I wanted to make a small change. We do not look at unemployment numbers from U3. We look at U6. That is in the north of 8. I think give or take around 8%. So if you factor, if you take U6 and then you add fuel and shelter and the food and the fuel, those are the things that they exclude. So if you add those things, we think that the unemployment number is already in double digits, around closer to 10. So if you
And
take that, right, um, we are seeing record 2008 level layoffs. We are seeing more layoffs happening. There are quiet layoffs happening. People are taking 2 to 3 jobs and trying to make the ends meet. So
bankruptcies are at 2008 levels, I saw.
bankruptcies are 2008 level. Corporate bankruptcies are increasing. So, consumers are going to hit a brick wall, but we couldn't triangulate as and when. That's because private credit is like bottomless pit in offering funding to BNPL. So you have billions and billions of dollars funded by private credit to BNPL like Affirm, Klarna. And as long as BNPL continues to extend credit to the consumers, they will be fine. But that does not indicate that the economy is fine. It means the more BNPL usage means our economy is in the worst position. I think the sooner people are asking us, oh, are we going to get a 2008 crisis or 2000 crisis? We are not going to get a one-off recession. You're not going to see 3,000 point drop and everybody is panicking. We're not going to see that. What we are going to continue seeing is a persistent depression and the expansion of lower K, and that will pressure the upper K, and which will cause kind of a social misalignment, so to speak, or
Yeah.
unrest because people don't have enough food. They have to pay in full for the food. People don't have money to even get their car reposition are going up, and you have new car value of $50,000. People just can't afford anything, and we are seeing the lower K expanding.
Are you expecting all of what you just described, including the increasing social uneasiness and unrest, to ultimately pressure government for more social safety net services somehow, whether that be, stimulus checks of some kind? I know we're hearing discussions about, we're going to give you a $2,000 person tariff rebate stimulus check. But are you expecting pressure to well up to force some kind of additional help coming from the top?
Yes, and the help that they did during COVID increased the inflation, and we
Right.
expect 2026 to see a reaccelerate inflation to reaccelerate. And of course, they're going to cut 50 basis point, which is fantastic. But what they are missing is that is not going to cascade right away. The economy functions on a lag, and doing 50 basis point cut is not going to help the bottom K. So we expect the inflation to go up, right? Especially the suppression, for the lack of better words, the data due to the government shutdown. We are not seeing a clear data of what's coming in, what's going out, and inflations are going to shoot up, and that's going to be a problem. So
Okay. So go
to
ahead.
answer
Sorry.
your question, giving another $2,000 check from the government is not going to fix anything. It's going to make things worse.
Yeah, I couldn't agree more. All right, so Lex, let's discuss the markets a little bit as you see them now. The Case-Shiller index, the Buffett indicator, valuations, other metrics in parts of the market are pointing to the being overvalued. Despite that, on a nominal basis, the indexes continue to keep rolling along. Do you view the S&P 500 and the Nasdaq closer to a lens of 1995, the beginning of the dot-com bubble, or closer to 1999, closer to the dot-com bubble popping? Like, where do you see it right now?
That is a very interesting question. And the correct answer is I think there is already a small correction that began in AI when IBM came out and said, we have no idea when the data centers are going to make any kind of money and how it's going to do it. So now we see the cascading impact on how that is going to set the tone on other big tech companies, whether they are pulling out their investments, capex investments from AI, and we will start seeing it in the first half too. So to answer your question, we see around like late 1998, early 1999.
Okay. Staying on the MAG-7 and the big tech stocks, Larry McDonald from the Bear Traps report, he's been on the show a couple of times, and we did a live conference with him. And he's been talking about how in the first quarter, specifically in the first couple of months, January, February, he's expecting smart money to begin paring down some MAG 7 investments to capitalize on profits, the massive profits, but being able to postpone taxes until first half of 2027. And he believes that that's going to put downward pressure on the markets. What's your perspective there?
I agree to that because I could not have explained it more clearly. So yes, we see the similar pattern playing, and we also see structural cracks in the on the fundamental level for other stocks, retail sectors and consumer sectors to widen.
So do you expect if there, okay, so there's a lot of market concentration with the Mag 7, right? It's actually hyper concentrated today versus previous eras. Um, if we start seeing downward pressure happening in the Mag 7, do you expect that to take down the majority of the market? And, you know, how far down does this go? You were saying you don't expect to see a significant drop, but rather more of a stagflationary, depressionary type movement. But
Yeah.
if smart money is exiting, the Mag 7, and with it being so hyper concentrated, wouldn't that have a massive impact on retirement accounts, pension funds, endowments, et cetera?
Excuse me. Yes, yes, it would. But what we are factoring in is the whether the administration would let it happen, right?
Okay.
So you have we don't get into politics, but there is no dancing around when you ask this question. So yeah, logically, when things happen, there is a downward pressure. We see we will see a lot of um sell-off, a huge sell-off, a huge correction. But then you have the administration, they they have been consistent in saying there will be a bull market, there won't be any downturn. So we have to factor that into account and see where the patches are going to come from. So there is no black and white, and it looks like everybody is playing in the gray area,
Yeah.
and
Yeah.
that's the problem we have in taking a stand.
Okay. So while you're talking, I'm picturing a chart that showed the NASDAQ in 2000 through 2003, and it's basically coming down like this, right? And I'm watching gold miners also in reverse going like this
Up.
during that same period of time. So there was clearly a rotation happening during that time from the NASDAQ to something that was hedged, and gold miners, gold, all of that was considered a hedge. So was bonds. Now we see bonds being in a secular bear market, and so you could make an assumption that gold and the gold miners are going to reap even more benefit if something like
Yes.
that happens. Do you expect a rotation of that money into, that's what I'm trying to get to, is these other assets, or are you expecting, rather than a rotation, more, let's get out of the way, let's just park the money on the side somewhere, we'll sidestep and then see what happens when the smoke clears?
From our clients' point of view, we see a lot of um, going into safe assets, hedging into gold, and some of them are okay. Fine, we will take the cash out, and we will sit on the sidelines. We will watch where the market goes in the first half of 2026 before making any major decisions. So that we see two of the same thing happening. One, some of the clients are going into increasing their position in hedging against gold, and some of them are choosing to stay in cash. And we do know some clients took the money out of MAG 7 and either A, put half in gold and half in cash.
So then let's assume, we have the market falling as smart money is pulling out of the Mag 7, but it's not like this, the bottom falls out, but it's falling, it's drifting downward. We're waiting on the administration, as you put it, to explain where the patches are going to come from. Do you expect this partial rotation then into gold and the miners to put a floor under them, or do you expect them to drop along with the broader market?
I think gold will continue to spike from where I stand. And in addition, we are seeing a lot of interest in shorting. And so those are the two things that we have been seeing. It's like gold is seeing as a hedge, and some of them are choosing shorting as a hedge against the uncertainty and volatility in the market.
So not shorting gold, but shorting the market.
Shorting the market, yes.
Okay. Okay. All right.
Not
So
the gold.
okay. So you're not seeing any, in your opinion, based on the research you've done and the clients you're interacting with, based on the volatility movement that you're expecting in the first half of 26, you're expecting stability to an increase in the metals and the miners
Yes.
simultaneously, very similar to what we saw during 2000 to 2003.
Yes.
Yeah.
And especially on um, lithium and other rare earth minerals. So we are seeing investments in there as well because of bringing everything back home rather than relying on abroad. So we are seeing not only gold, but also rare earth elements.
Very interesting. Okay. So are there specific sectors right now? Is it the broader commodity sector, or is it other sectors that you believe right now are good opportunities to maybe front run what you see coming in the first half of 26?
In addition to gold, we are very optimistic, for the lack of better words, in investing in rare earth elements and companies that are investing in them in
Okay.
the United States.
Okay, so you like the district of the United States. Are there sectors specifically right now, Lex, that you believe are overvalued in addition to the MAG-7 that you are looking to exit out of, that could get caught up in that downdraft in 26?
In addition to MAG-7,
Yeah. Yeah. Or is that, I know that the 400 and the other 493 companies that are in the S&P have essentially, they've been down for the large
yeah,
part,
yeah,
you know,
yeah.
but is there a specific sector, obviously it seems like you like maybe the metals and some of the base metals for maybe the grid and
Yes.
for certain applications that we need for military or that we need for computing, but maybe some of the commodity areas like oil, which a lot of people are very high on right now. Are you as high on oil, or do you feel like oil is going to continue to be in a downdraft?
Let me put it this way. The ones that we are very optimistic about is the infrastructure. Anything that has to do with the infrastructure and the supply chain is we are bullish. There,
Yeah.
you made me say the B word. So anything infrastructure and the supply chain that assists the infrastructure, we are bullish. Anything that is related mining related rare earth elements that is critical for lithium and other aspects of the technology, we are very optimistic. Gold, we are optimistic. So other than that, I think anything that says AI in front of it has to will cascade down along with the MAG-7. For instance, we recommended GE Vernova as the short when it was around 600-ish. It went down around 200 and something. We wrote a cover, and then it rallied back. It rallied back because of data centers, because of the opportunities in the data centers. So the valuation was purely based on what it will see 2 years, 5 years from now. So companies like that and the SMRs, are they going to cascade down? Oklo is a classic example.
Okay. When we move into the asset ranking lightning round, I am going to ask you about uranium, but not specifically a mining company, like like Aklo, but this has all been incredibly interesting, and I really appreciate you being here. We have some more to go here, but I just want to welcome everyone who's tuning in to this fantastic interview with Laks Ganapathi, CEO of Unicus Research. Before we wrap up with the final set of questions, I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report that you'll receive. Now, I'm positive you've been enjoying the conversation that Laks and I have been having. Please let her know. Hit the like and subscribe button and leave a comment below the video. All right, Laks, so we talked about this asset ranking lightning round. I'm just going to ask you to rank some assets 1 to 100, 100 being an extreme buy, 1 being an extreme sell. Just give 1 to 2 sentences as to why you take the position. We'll roll through these really quickly. It is a lightning round. Okay, so we'll say for the next 6 months in terms of time frame, just to give some points here. So right now, on a scale of 1 to 100, is gold a buy or a sell, and why?
100, it's a buy. It's a safe asset, and it's the more market is volatile, the more safer gold appears to be, and we continue to believe that.
Awesome. On a scale of 1 to 100, are gold miners a buy or a sell, and why?
100, because you always need the shovel. So the miners are the supply chain that goes into the process, and we rate 100 for that.
Okay. Silver, 1 to 100, and why?
I'm not as equipped with silver as I am with gold, so I am going to say somewhere in the middle, like 50.
Okay. Copper, is copper a buy or a sell, and why? 1 to 100.
Buy. It's 100, and because again, it goes into the supply chain aspect of anything and everything that we need, and it's a part of the infrastructure, and that's why it's 100.
As just staying on copper for a quick moment, as we move deeper into this infrastructure build out with the grid and raising up the Asian circle and everything around the world that we need, are you expecting there to be a supply deficit for copper?
There might be, yeah.
As being reported?
There might be, yes.
Okay. All right. Moving on to the next asset. 1 to 100, is uranium a buy or a sell, and why?
100, it's a buy, because in this geopolitical environment, that is the answer.
Okay. Oil, 1 to 100, and why?
Oh boy.
That's a tough one.
That is a tough one. I'll tell you why, because it involves a lot of political pressures and all the in-house closed door meetings. So I would just not take anything on that. Sorry.
That's fine. That's fine. All right. So let's move over to the broader markets, the NASDAQ, 1 to 100. NASDAQ a buy or a sell, and why?
For 2026?
Yeah, for 2026.
It's a sell, because everything is AI, and we think it will cascade down. Yes.
So how low would you put it on the scale from 1 to 100?
10.
10. Okay. Let's move over to the S&P. Do you distinguish the S&P different from the NASDAQ? I know it's heavily concentrated with MAG-7 in there.
Anywhere there is an AI, I just take the same stand as NASDAQ.
Okay. All right. So let's move over to treasuries, the short-term treasuries, 1 to 100. I mean, do you look at it just for optionality, or do you look at it, as an investment?
I would say 100.
You would. Okay. And you like the optionality on it?
Yeah.
Yeah. Okay. All right. Let's move over to long-term treasuries. Do you like the potential opportunity there? 1 to 100?
100, yes.
You like long-term treasuries. So you're expecting a big move there.
Yeah.
Do you expect treasuries? I know the long end here on the 10-year anyway is drifting higher over the last week or two. It hit 4.17 the last I saw as far as a high. Are you expecting this to get to a breaking point around that magical 5% mark before maybe they come in and do something?
I'm not taking a number on that. No, sorry.
Okay. All right. On a scale of 1 to 10, each representing a percentage, where do you see inflation ending 2026? You mentioned you believe it's going to come roaring back.
You mean if the numbers are right?
Yeah, well, let's base it on their numbers. So right now they're around what, 3%?
Yeah.
I mean, it's not true, but based on their numbers, where would you think that they're going to report inflation at the end of 2026 or mid 2026?
Their number, I would go with 5.
Oh, so they'll even have to go higher. So then you're expecting us to maybe get somewhere around the 12, 13, 14%?
Yes.
Wow.
I mean,
Okay.
it's all with the tariffs, right? It's it's been like on and off, on and off, on and off, but the impact cascades and people have to make decisions. And if you see trucking is getting killed. And
Yes, it
all
is.
the other data is backward oriented. Trucking is very forward oriented. And trucking is saying, signaling us that things are not going to go well in 2026.
Okay, so 1 to 10 probability. Are we headed into a recession, by mid to third quarter of 26? Like coming into the midterm elections, are you expecting a recession?
I expect any and all kind of different varieties of band-aid to be put on the economy to
Yeah.
avoid that recession. But what we expect is a consistent growth in the lower K from the upper K cascading down. And that is not a good news.
Okay, so that lower K that's expanding, they're going to be in recession.
Yes, they already are.
And it's growing. Okay. All right. So finally, the recommended portfolio allocation, it's been 60/40 forever. Nobody has, up until recently, with Morgan Stanley's saying, let's go 60/20/20, 20% gold. Nobody ever is recommending gold in the portfolio. Are you recommending, a rough allocation for gold moving into this new time period, that we're entering? 10%, 20%?
We don't recommend that to our clients because we are purely short based. But if you suggesting me to take a stand, I would recommend around 20-30% to be on gold or short side, but either or.
I appreciate you answering that. Thank you. All right. So, Lax, would you please share a key takeaway that you want the viewers to keep in mind about anything from the short side to the economy, to the market, to the monetary situation? And then after that, let everybody know where they can learn all about Unicus and how they can connect with them and you personally.
Thank you for having me. And one thing everybody needs to remember, if you don't understand what a company is doing, if you don't understand how they are doing it, don't invest in it. If you wanted to short or long any kind of company, no matter how successful anybody's previous recommendation is, do your own due diligence and question and do a pushback. Just following the crowd, especially in the investment, both on the long and the short side, because of the fear of missing out is not healthy for your portfolio. And the last thing is um, just read as much as you want and understand the sector that you're investing in. Don't invest with friends and families. And the last one, you can go to unicusresearch.com for reaching out to us, or for retails and people who don't want short ideas but want to understand how the credit market is transforming in 2026, how the defaults are happening. You can always go to contrarianunicus.substack.com and you can follow us there.
Wonderful. And you're on X as well?
We are on X as well at Unicus Research.
Wonderful. I'll have all of the information up on the screen. It'll also be in the description area. So, folks, you can click through and get right over to where Lax is located in any of these platforms. Lax, I really appreciate you coming on to Metals and Miners, being so generous with your time, analysis, and ideas. It's been a lot of fun to spend the time with you. I look forward to having you back on sometime soon. And everybody else, thank you for watching.
Thank you so much for having me.
I just want to direct everyone who's interested in the metals and mining sector to dive into our Substack at metalsandminers.substack.com. Join the quickly growing community and receive a free report. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." That's a famous quote by investing legend Ray Dalio. That's also the name of the report that you'll receive.